Good evening, everyone. Time for another silver update. What you are looking at here is a chart of the US dollar Japanese yen. We had what could be described as a catastrophic collapse around a little after 5:30 p.m. Eastern Time. Now we went from approximately, we'll just say 80 to 76, so a full 4-point move on the Japanese yen. That's the dollar going down against the yen. So I'm going to go ahead and explain a number of things here. I've had a number of requests regarding the carry trade and charting, etc. So I'm going to try to address those issues. Going to do some silver, but mainly talk about currencies and interest rates, etc. So this move in the Japanese yen US dollar cross, as I said before, to speak of moves in currencies is meaningless if you're just talking about the currency isolated in the world. So to say the dollar went down today, that's a meaningless statement, because you've got to say the dollar versus what went down. So this chart is showing that this 80, let me explain for people who don't understand, this 80 is 80 yen per dollar, and this move is 80 to 76 yen. So when at this moment it took 80 yen to buy $1, at this moment it took 76 yen to buy $1. That's a 4-point move. That's 5% of 80. So what that means in terms of Japanese yen, the dollar lost 5% of its value. Or people who hold dollars who intend to buy things from Japan lost 5% of their buying power. Or another way to put it is inflation in 1 minute, or actually a couple minutes, there was 5% inflation in terms of goods bought from Japan. They went up by 5% in price. Now you can see we had a tremendous bounce. My guess is this was central bank intervention. Now some have asked me, well, which central bank was intervening? Well, it's going to have to be the Bank of Japan, because this intervention is going to be the selling of the yen. So who can sell yen except the Bank of Japan? Obviously the United States has very little yen. So this intervention is going to be BOJ intervention. Now this breakdown, it's a pretty strong technical breakdown. As I've shown the chart before, the support goes back all the way to 1995, and you can see the rally came right back up to where it dropped from. This is a huge shakeout. We're talking 4-point drop, 4-point rally, and for the most part, in technicals, when you have what is called an outlier move, this is an outlier move, a sort of black swan type event. In other words, an event that can't be predicted by standard probability and statistics. Standard normal probability and statistics, normal deviation from the mean, does not predict these type of outliers. So most technicians will tell you that when you have a outlier event like this, that markets tend to move in the direction of the outlier event. Now, we had one back here, and then we had central bank intervention. It took a while to come down. Another intervention, another intervention. This one actually went below support. It penetrated into a new low, a new short-term low. It wasn't a long-term low. I'll show you that in a second on the chart. But so we did have a dramatic move, and the tendency is to move in the direction of those outliers. We're starting to see this is a tremendous outlier event, but there's a 90% probability that the market will continue in this direction. Even though intervention rallied it back all the way to the break point, and there's a lot of things involved there. There's a lot of people busted. There was a huge number of people on the Forex desks that were busted here and here. Completely bankrupt, had to carry them out with that type of a currency move. But it's a tremendous move. Now I wanted to look at some of the other currencies. We want to look at the other yen crosses. This is a British pound cross. We can see a similar pattern. And we can look at, here's New Zealand dollar cross, similar pattern. Let's look at a Canadian dollar cross. Not quite as extreme, but similar pattern. And let's look at Australian dollar cross. Not quite as extreme. And I think we have a Swiss franc. That's about it. Swiss franc cross is dramatic and then completely all the way back. So now that's pretty simple. By looking at all of those, one would conclude that we have a tremendous rally in the yen versus all currencies. Now that's pretty simple until you look at something like a American dollar. Let's look at a US dollar Swiss franc cross. And now we see the same sort of dramatic move. So how do we account for this? And we can look at a, let's do a US dollar that one doesn't give us anything. We don't really have that many crosses on this chart, so I can't really give that to you. But the point is that if we went through all the crosses, here's the US dollar Canadian cross, not really a lot there. So just showing up in the Swiss franc, let's look at the US dollar euro cross, not a lot there. So one would have to say that the majority of the move is in the Japanese yen, but there is some follow-on move in the US dollar with other crosses. So that brings me to what I wanted to explain about, a lot have asked about this Japanese carry trade, what it means and how it works. So let's take a look at that. This chart here is the Japanese government bond yields. It's a yield curve for JGB, Japanese government bonds. Now, if you recall, the Japanese were the first to go to ZIRP, zero interest rate policy, ZIRP. They were the first country to do that. They experienced a crash in their stock market around 1990. Let's pull up the chart. Go to Yahoo in Asia. We'll check that. We're down to 189 on the Nikkei, which is bad, but it's not as bad. So if we look at a max chart on the Nikkei, we had a crash that started in 1990 from about 40,000 on the Nikkei, and we dropped down to 15. That's a big loss. over 50% here. We dropped all the way down to about 8,000 or so, and then a little bit lower than 8,000. And now if we come to our, let's look at our 5-day, we actually touched down at 8,200. So we've almost touched the lows that we hit from this entire bear market that started in 1990. Now, ever since this bear market started in 1990, the Japanese have pursued ZIRP, zero interest rate policy. And you can see from this chart of JGB yields, let's look at some of these yields, okay? The yield on the 3-month Japanese Treasury is 0.13%. That's 0.1% interest. So let's go out to the year, 0.15. What that means is if you loaned money to the Japanese government for a year, for every $100 that you loaned to the Japanese government, you'd get 15 cents. Not a great yield, to say the least. So let's go out to the 2-year. We're at 23 cents. 3 years, 25 cents. The 5-year, 50 cents. So for every $100 you loaned the Japanese government, they'd give you 50 cents per year in 5 years. Let's go out to the 10-year. $1.21, 1.21% interest rates. All the way out to the 30-year is 2.23%. So you can see that the interest paid by the Japanese government on loans is a ridiculously low rate. That's ZIRP, zero interest rate policy. Now, that's how we get to the Japanese carry, the yen carry trade. So, what the yen carry trade is speculators and perhaps even governments, other individuals, borrowing money at these tremendously low interest rates. It may be for this period, it may be for 2 years, it may be for 5 years. And then what they do is they take the money they borrowed at, let's say you got 5 years. So we go to a Japanese bank and we borrow, say, $1 million at 0.51. It's going to be higher because this is what they're paying, so it's going to be 0.75, let's say. So I can get a 5-year loan in yen for less than 1% interest. So for all intents and purposes, my interest rate that I have to pay them is nothing. So I'm getting free money. So the question is, what do I do with the free money they give me? Well, there are other countries that are not involved in a zero interest rate policy. They're yielding reasonable rates. So for example, a 10-year note, you might see in Australia, I'm just guessing, these aren't real rates, but in Australia you might have 5%, or in Europe you might see 6%, or in Greece bonds might have 8 or 9%. So what these people are doing is borrowing money in yen, and they're converting it to whatever currency they are investing in, the bonds of, they're buying. So if, let's say it's Greek bonds, they would have to take this yen and convert it to Greek drachma, or whatever that is, and then buy the bonds. And once the maturity, or whenever they've speculated they should get out, they would reverse that to take their profit, and they would sell those Greek bonds, and then they would owe a loan in Japanese yen. So they would have to buy yen to pay back the loan. So that's consistent. Now, there's an article on Zero Hedge that talks about this. Is this the unwinding of the Japanese carry trade that we're seeing here? And so you can understand why. Now this is a dollar yen chart, so it's going down, but if this was a yen dollar chart, it would be going up. So the yen is appreciating. So you remember that the people who are paying back these loans that they've taken have to buy yen to pay them back. So the reversal of the carry trade will result in a rally of yen. And that's what we see here. We see a extreme yen rally against the dollar, and as I pointed out, against all these currencies. Now, I haven't done a study. Well, that's dollar pound, but that's pound yen. I haven't done a study of comparative interest rates to how these currencies are performing versus the yen, but my guess is that the stronger the interest rate relative to the yen, you probably see the currency moving dramatically. So it does appear that zero hedge is correct, and we'll jump on there real quick because things are changing really rapidly. Everything's about Japan. So it does appear that zero hedge is correct, this article. The day the yen carry trade died. It does appear that the yen carry trade is in reversal now. Now, another interesting point about this is that the United States government is the next government that is pursuing ZIRP. Bernanke has taken U.S. interest rates, and on the short end, which he controls directly, has set them at nearly zero. And the Fed is involved in buying long-term and medium long-term bonds in the open market, which has the effect of pushing down long-term rates. So short-term rates are compressed, long-term rates are being compressed, and the middle of the curve is being compressed as well. So the United States is following Japan in the idea of zero interest rate policy. And as we see, zero interest rate policy in Japan seems to be collapsing. Now, when we look at the Swiss franc against the US dollar, it's, well, here's Swiss franc, Japanese yen. I showed that before. But Swiss franc, US dollar is, we've got a big decline here. So the question is the carry trade in the United States collapsing as well, or is there a rush towards the United States carry trade because the Japanese carry trade is collapsing? So there are two possibilities. One is all carry trades are collapsing. The other is the Japanese carry trade is collapsing and the United States carry trade is increasing. You have to remember that all of these carry trades, anytime someone borrows money in one currency and invests in another currency, their main risk is currency risk, because they can lock the rates respective. They can borrow at 0.2% and they can invest at 5%, but what is going to happen to the respective currencies? If the one currency depreciates by more than 5%, even though they have a 5% yield, they've lost money because of the change in the currencies. So the carry trade requires stable currency rates. And we can see here the currency crosses are anything but stable. So it would be expected that this carry trade would unwind. So we may be looking at the unwinding of the Japanese carry trade, and perhaps the early U.S. carry trade may also be unwinding, or the money rushing from the Japanese carry trade, maybe rushing into the U.S. carry trade. Can't say for sure at this point. So right now I wanted to jump over to silver. I had a number of people ask me about the charting. I said earlier that this falling triangle should fall at increasing rates based on these drops, and it hasn't. It actually rallied and broke to the upside and then fell to the downside. Now we're still at support, which is interesting. We're still at support for the long term. You have to remember that these charting rules, and they're not rules, but they're just kind of tendencies. A lot of them work out 75%, 25% fail. When you're talking about extreme events like nuclear disasters, stock market crashes, and carry trade unwindings, pretty much all of those rules go out the window. So at that point, we're pretty much just looking at what has happened. It becomes very difficult to predict what will happen because we don't have a generally trending market. We have a market moved by news, violent news in each direction. So I understand that people want the predictive power of things like Fibonacci's, support, resistance, but when news moves markets in extreme directions, all those things go out the window. The fundamentals ultimately rule, and the news is kind of a preview of the fundamentals. They may or may not come to pass. We may move violently in the other direction, but the news and fundamentals trump everything ultimately, because that's the direction markets are going to move. So just based on the technicals for silver, it's very strong. We're roughly near 34. We're looking at a extreme unwinding of the carry trade, which would be bearish for the dollar, but at the same time it's extremely it's just a discontinuous event, so that we can't expect anything to come out of it until the trend develops, and then we can look and analyze how the markets are going to move. So right now I think that silver and let's pull up gold are actually performing very well in the face of this type of an event. It does not appear to be a deflationary event. It appears to more be a currency event, and the dollar is falling rapidly, and I would expect that if this continues in a general line, that we will see a bounce and the precious metals will respond and rally due to the decline in the dollar. But at this point, all bets are off. We can't really say what's going to happen. We need to wait and see what happens with reactors in Japan, and what happens with the carry trade in Japan, and potentially the carry trade in the US, where interest rates go in all of those countries. And there's a lot of things up in the air, so hopefully we'll get some lower prices and we can get more silver at a lower price, but we don't know where it's going to go at this point. Just keep stacking, and we'll talk to you next time.